back to this top story. S&P Global Ratings has retained its positive outlook on South Africa. It cited the country's strong financial markets and an improved fiscal and debt position. However, the ratings agency warns that there are a number of threats, including a slowing global economy as well as rolling blackouts. Let's speak now to eNCA business editor Devan Murugan on this. Devan, always a pleasure speaking to you. A very good morning. Before we get into the details, just remind us a little bit why reviews by these rating agencies remain so important.
Yeah, no, they definitely do. Good morning, Faith. Well, essentially, let's just ask ourselves, what does a rating agency do? Well, what it does is that it assesses the country's ability to pay back debt. So it identifies the risks of any corporate, for example, a government entity. And when it sees that there are risks to a government making money, strengthening its tax revenue, then that rating becomes unfavorable. Now, why this is important is because investors use those ratings to decide how much they will charge in terms of interest for a government. And as you know, with our debt situation the way it is, we would want a favorable rating from these rating agencies because we would want our cost of borrowing to be lower. And essentially, you've got these three major rating agencies that we look to: Moody's, Fitch, and of course the one that gave us a note last night, overnight, S&P Global. Faith.
Well, on the other side, S&P has kept a positive outlook for South Africa, but we also remain in junk status. And how does that work?
Yeah, that's correct. I mean, we've lost our investment grade status, our last remaining investment grade status way back in 2020. And essentially, what it means is that South Africa no longer has that investment grade, and the amount it is charged for borrowing money is higher. So we are in junk status. We've lost it, as I said, in 2020. And why we did that, why did we lose that the investment grade status, was because these rating agencies essentially felt that our growth was limited, this economy was not growing, unemployment was high, and we didn't have the correct policies in place to stimulate growth. So we've lost it. Essentially what happened overnight is that S&P said, well, look, you're still in junk status, but the outlook is somewhat positive. And why did they say that? Was because, well, we've just had a medium-term budget. And that budget looked pretty good in terms of our debt trajectory. We still have high debt, but it seems to be managing it. The other thing that S&P said was that we had a higher tax revenue intake than anticipated at the start of the year. That's another positive. And then, of course, it also highlighted the fact that we're beginning very slowly as a government to introduce the private sector into some of these major public enterprises. Now, if you look at the issue of renewable energy, we're getting those private sector players into that space. There are one or two private sector initiatives to get into the country's logistical, that's Transnet functioning, also Eskom for that matter. So those are the positives in that regard. What S&P is saying, your outlook now would be a bit more favorable, but we remain in junk status, Faith.
In terms of just looking at the threats to our economy as S&P see it, I know that power supply, or the lack thereof, Devan, remains a very contentious issue, but let's talk a little bit about some of these threats.
Well, I think that is the biggest threat, Faith, because if you look at it, if you do not have power, you cannot get conveyor belts turning in factories. And when that doesn't happen, you've got lower economic activity, you've got fewer people employed in jobs at these factories. So number one big threat is the fact that we still need power stability in this country. If that falters even further, that does have a risk to our rating, and that will mean that the longer it will take for us to get back into investment grade. The global environment is something that we don't have much control of, but that's another big risk. Remember, most of that revenue and tax intake that we've been getting that was higher than expected this year came from countries buying our commodities. And if the global economy is weaker, they buy less, that's another risk. But there are also things that are in the long term. S&P and all these rating agencies have always flagged. They say, get your growth stimulating policies in place. Remember, previously, the rating agencies also flagged that there was just too much infighting, political infighting, and people concentrated less on stimulating the economy. It will be interesting to note that they would watch out for the ruling party's elective conference coming up in December. What sort of market-friendly, business-friendly policies would emerge there as proposals to lift up the economy? That's another big one. But I mean, all in all, we've got to get growth coming into this country. We've got to get the lights working and conveyor belts turning, as I said. Essentially, those are some of the biggest threats. And then, of course, the last one before I go is the fact that we've seen such a big default in the country's logistical state. Transnet. We've got trains falling off the tracks. We don't have a network that will supply companies to get their goods out to the export market. So logistically, we do have some problems as well. I think that the ratings agencies will keep a keen eye on some of those things, Faith. But as it stands now, I think it's a positive that we've got a positive outlook from S&P. Still a long way to go, though, before all three rating agencies take us out of junk status.
Devan, before we let you go, this notion of us borrowing and borrowing and borrowing, we saw it particularly during the 2020 COVID-19 pandemic. And its peak, government needed a way to be able to sustain itself, plus be able to acquire some of these vaccines and the like. We saw what impact that it had on our economy. So on one side, the country keeps borrowing, right? And on the other side, because of our ratings, the interest on borrowing is at an amount that is quite high. So then who pays for the debt? And how then is the debt actually paid?
You're quite right. I mean, what is it? The 20% of what we have in our budget goes to paying debt servicing costs. What are we looking at? I think the number was about 71% of GDP. That's our debt status. So if you take our entire GDP, 71% of that is how much we owe in debt. It's a staggering figure, but it's something that we have to get under control. In fact, the only way a lot of economists say you can get that under control is create employment, create jobs, so that more people are in work and they can then pay out tax revenues, and that goes into the coffer. The other big thing I forgot to mention in the earlier answer is that the rating agencies are watching the status of our wage negotiations, because remember, we've got about a third of our expenditure in this country goes to paying wages. Now, as justified as the unions might seem, if we continue to grow that wage bill, it's just less money going into hospitals, schools, and building roads. And what happens, to answer your question, you go up there and borrow more money. So those are also sort of key issues that rating agencies would be watching. But you're quite right. We cannot let this debt get out of control. What S&P said last night was that it looks like you were containing it somewhat. Let's just hope that it stays that way and improves.
Devan, we'll leave it there for now. eNCA is a business editor. Devan Murugan joining us this morning. Much appreciated as always. Let's move